Welcome back to the Deep Dive. It's Tuesday, February 17th, 2026. And I have to be honest with you, if you've been sneaking a peek at your brokerage app, maybe at lunch or, waiting for your coffee this week, you might be feeling a little motion sick.
Motion sick is probably the polite way to put it. It's been a roller coaster.
Right. Because for the last, 3 or 4 years, the strategy was almost stupidly simple. It was the set it and forget it era.
Oh,
You
absolutely.
just buy big tech, you buy the Mag 7, go to sleep and wake up richer. But looking at the stack of research you brought in today, the party seems to be moving.
It is. And the usual suspects aren't invited.
It feels like it. And if you're just an index investor,
Yeah.
Someone who just buys the S&P 500 and assumes everything is fine.
You're likely seeing red in your portfolio while so much else is actually flashing green. We are in the middle of what strategists are calling the Great Rotation.
Great rotation.
Okay.
Okay, it sounds like a dance move, but I assume it's a lot more expensive if you get the steps wrong.
It's definitely more consequential. Yeah. We are seeing a historic amount of capital leaving that crowded, hyper-expensive tech trade
And just flooding into where?
into the real economy. We're talking small caps, energy, industrials, things that you can, touch.
So our mission today is to figure out if this is just a blip, a little correction before tech takes off again, or if the world has actually changed. We need to unpack why energy stocks are crushing it, even though oil isn't skyrocketing.
And we have to talk about the elephant in the room.
The Federal Reserve.
And the drama at the Fed is thicker than it has been in, decades.
Exactly. We've got a pause at 3.5%, a fight over leadership between Powell and Warsh. It's a lot. But okay, let's start with the market itself. You sent me a chart about the Russell 2000. That's the small cap index. And I honestly thought it was a typo.
It looks like one, doesn't it? But it's real. As of mid-February, the Russell 2000 hit a 15-session winning streak against the S&P 500.
Hold on. Let's just make sure everyone gets the magnitude of that. 15 days in a row with the little guys beat the giants.
15 consecutive sessions. And to put that in perspective, we have not seen a streak of small cap dominance like that since May of 1996.
1996. Wow. I was wearing flannel and listening to Nirvana. That is 30 years ago.
It is. And just think about what that means. For 3 decades, the market has generally favored size. Scale was everything. But right now, investors are saying, we are done paying a massive premium for the giants.
But play devil's advocate for a second. Is this healthy? Usually when the Mag 7, Apple, Microsoft, NVIDIA, all those guys, when they sneeze, the whole economy gets pneumonia.
Right.
Are we saying the market is going up without them? Because that feels a little unstable.
That is exactly what's happening, and I'd argue this is actually good news. It's all about something called market breadth.
Okay, define that. Because when I hear breadth, I think about how wide the rally is.
Yeah.
But break it down for someone who doesn't stare at Bloomberg terminals all day. Why should they care about breadth?
Sure. Imagine the stock market is a wagon being pulled up a really steep hill. For the last few years, you had 7 Clydesdales, the Mag 7, pulling 90% of the weight. The other 493 horses in the S&P 500 were just kind of walking along. The rope was slack. They weren't contributing.
Danger is one of the Clydesdales trips.
Exactly. And that's what happened in January. Tesla, Meta, Apple, they started tripping. They are lagging or in correction territory. But the wagon didn't stop.
Why not?
Because the other 493 horses finally dug their hooves in and started pulling. Right now, over 60, maybe 65% of the stocks in the S&P 500 are outperforming the index itself.
So the average company is finally doing better than the superstores.
Precisely. In January alone, value stocks, boring, steady companies, were up over 4.6%, while growth stocks, your tech darlings, were down over 1%.
That's a massive divergence.
It is, and it tells us investors aren't fleeing the stock market in a panic. They're just moving money from the penthouse down to the basement where the bargains are.
Okay, so they're hunting for bargains, but they seem to be finding them in places I really did not expect. I looked at the sector performance you highlighted, and energy is up 20% year to date.
It's the best performing sector of 2026 so far. The XLE ETF is it's ripping higher.
See, here's where I get skeptical. Usually, energy stocks fly when oil prices go parabolic. Are we back to $100 a barrel? Am I about to see $6 gas at the pump?
That's the aha moment here. We aren't. WTI crude is trading somewhere between $63 and $70. It's stable. It's not cheap, but it's certainly not skyrocketing.
So if the commodity they sell isn't spiking, why are their stock prices up 20%? That feels like a bubble. or just pure speculation?
It's not a bubble, it's a realization of value.
Oh.
There are two things happening. First, U.S. producers have become incredibly efficient. They're pumping record output at lower costs, so they are profitable even at $65 oil. But the second driver is actually AI.
Wait, so I thought we just said investors were rotating out of AI.
They're rotating out of AI software valuations. You know, the companies promising chatbots that might change the world in 10 years. They're rotating into AI infrastructure.
The plumbing.
The power. Specifically, the power. Data centers are popping up everywhere, and they are incredibly thirsty for electricity. You can't run a massive language model on good vibes. You need megawatts.
So the utility companies and the gas companies were basically the new picks and shovels trade for AI.
Exactly. Utilities are up about 3% recently for this exact reason, this whole electrification narrative. The market has realized that if the tech giants want to grow, they have to pay the energy companies to keep the lights on.
It's a transfer of wealth from tech to energy.
That's it. It's a fascinating shift. It's almost like the digital economy is finally hitting the limits of the physical world.
And that theme, the real economy, is bleeding into industrials and materials too.
Oh, absolutely. Investors want companies that make physical things, have actual cash flow, and aren't trading at, 50 times earnings.
Which brings us to the entity that controls the cost of cash, and by extension, the entire economy. The Fed. We just had a meeting in late January. I saw the headline, Fed pauses, but looking at your notes, there was a lot more tension in that room than the headline suggested.
Much more. So officially, they held rates steady in that 3.5 to 3.75% range.
Okay, so no cut. But didn't they cut 3 times last year? Why stop now?
They called it a hawkish hold.
Translate that for us.
Well, a dovish hold is we're pausing, but hang tight, we might cut soon. A hawkish hold is more like we're pausing and don't you dare ask for money because the economy is too hot.
Too hot.
Really.
Like, with everything going on.
Well, Goldman Sachs is projecting nearly 2.8% GDP growth for 2026. That is what we'd call sturdy. The Fed looks at that and says, the economy is fine. If we cut rates now, we risk reigniting inflation. But, and here's the drama, it wasn't unanimous.
Oh, there were dissenters.
2 of them. Governors Waller and Marin actually voted to cut. They think the Fed is being too tight and risks choking off this growth.
So we have a split house at the Fed, and this is all happening right as the landlord is about to change. Jerome Powell is out in May, right?
His term ends in May 2026, and the transition is, let's just call it tense. President Trump has nominated Kevin Warsh to succeed him.
Okay, Warsh has been around a long time. He's a known quantity. Why is the market so nervous about that?
Because Warsh is seen as more dovish, but also maybe more political. The markets are pricing in that he might come in and slash rates to juice growth. But the bigger issue isn't just the rate cuts, it's the institutional fight. Our sources are mentioning DOJ investigations and Supreme Court cases regarding Fed governance that are all surfacing right now.
That sounds incredibly unstable. I mean, usually the Fed tries to be boring. They pride themselves on being boring.
This is not boring. It's an unprecedented tug-of-war over central bank independence. And investors hate uncertainty. They can handle bad news, but they cannot handle not knowing the rules of the game.
Right. If the market thinks the Fed is becoming a political arm, that changes the risk calculation for everyone.
It does, and yet, despite all that legal noise, the market hasn't crashed.
Which is pretty resilient.
Very. The market seems to be saying, we don't really care who runs the Fed as long as small businesses are making money and the real economy is chugging along.
Before we broaden this out to the rest of the world, because apparently the U.S. isn't the only place with money, I want to take a quick second to talk to you, the listener. If you like what you are listening to today, we invite you to subscribe to the channel, leave a like, and comment on what topics you would like us to address in the next episodes. In the description of this episode, you'll find the PayPal link in case you want to support this project. Your contribution helps a lot so that we can continue making content like this. We do not ask for more than the cost of a coffee. Thank you for your support. Okay, so we've established that the U.S. market is rotating into this real economy. But you mentioned earlier that if I'm only looking at the U.S., I'm missing half the story.
You really are. For the first time in a long time, international markets are actually outperforming the U.S. in some key areas.
Where's the money going? Is it Europe?
Europe and emerging markets are seeing significant inflows. A lot of this is just currency math. The dollar has weakened a bit, which makes foreign assets worth more when you convert them back. But you have to look at Japan.
Japan keeps coming up. I feel like for 20 years, Japan was a do-not-touch zone for investors, and now it's everyone's favorite comeback story.
It is, and it's driven by governance. Japanese companies are finally focusing on shareholder value buybacks, dividends, stopping the hoarding of cash. And investors are rewarding that behavior. It's a structural change, not just a momentary trade.
But it's not all happy returns globally. The research stack had a section called the Wall of Worry. What's keeping the big money managers up at night?
Geopolitics. It's heating up again.
Right.
We have new tensions involving Greenland, which is a bizarre new flashpoint over resources, plus the ongoing issues in Venezuela and Iran.
Greenland? Really? We're worrying about Greenland now.
It's all about rare earth minerals. Again, it comes back to the real economy. Everyone needs the physical stuff to build the tech. Greenland is sitting on a lot of that stuff. And because of this friction, we are seeing a massive flight to safety. Just look at gold.
I saw a number in the notes that I honestly did not believe. $5,400 an ounce.
Some sources are citing prices crossing $5,400.
That is staggering. That's basically double what it was just a few years ago. I mean, that sounds like doomsday prep, honestly.
It is historic. But think about the contradiction there. On one hand, investors are buying small caps, which is a risk-on trade, right? A bet on growth.
Right.
On the other hand, they are hoarding gold, which is the ultimate the world is ending insurance policy.
It's a schizophrenic market. It's like, I think I'm going to get rich, but I also think the bank might burn down.
Exactly. They want exposure to the real economy, but they don't trust the stability of the system, mostly because of that Fed drama and the geopolitical flashpoints we just talked about.
So let's bring this down to earth for the person listening to this on their commute. I'm sitting here, I have my standard portfolio. Maybe I was heavy on tech because, well, that's what worked. What does this great rotation actually mean for my strategy? Do I sell all my tech?
I wouldn't say sell everything, but you have to realize that the autopilot era is over. You can't just buy the index anymore. The experts are calling this a stock picker's market.
Which sounds like a lot more work.
It is more work, but the math is compelling. Tech is trading at roughly 28 times earnings. That's expensive. Small caps are trading around 18 times earnings.
So you're getting more bang for your buck in the small stuff.
Correct. And remember, small caps benefit the most from the domestic U.S. economy. If we really are seeing 2.8% GDP growth, the local manufacturer or the regional bank benefits more than Apple does.
That's a good point.
Apple needs the whole world to buy iPhones. The regional manufacturer just needs the U.S. economy to stay sturdy.
What about playing defense? If I'm worried about Warsh and Greenland and the Fed, where do I hide?
Quality. That's the key word. You look for dividend growers.
The boring companies that pay you rent.
Exactly. Companies with strong balance sheets that pay dividends. As volatility rises, and it will, getting a 3 or 4% check every quarter just for holding the stock becomes very attractive compared to a tech stock that might grow 20% or might drop 20%.
It feels like we are going back to basics. For 10 years, investing was about narrative. Who has the best story about the future? Now it feels like it's about numbers. Who actually has the cash today?
That is the perfect summary. The real economy is the red thread connecting all of this. Energy, industrials, infrastructure, the companies that build the world, power the world, and move the world. They're taking the baton.
And tech.
Tech isn't dead.
Yeah.
But it has to justify its price tag now. It's not enough to just say AI. You have to actually show the profit.
It's a show me the money market. I like that. It feels healthier, even if it's a little bit bumpier.
It is healthier, but maybe just one final warning.
Okay.
Watch the labor market.
The unemployment rate.
Right. All this optimism relies on that sturdy economy. If unemployment starts to tick up, this whole rotation could fall apart. That is the real risk to watch.
Always a cliff edge somewhere. But hey, at least now we know why our tech stocks are stalling and why the oil companies are winning. It's about getting real. And with this, we reach the end of this episode today. We hope you liked it, that you learned something new, and that you will join us in the next one. Thank you very much, and we will meet again very soon. Remember that the PayPal link is in the description of this video in case you want to help us. Thanks once again. Greetings. Note, hello, have a very good Tuesday.